So welcome everyone again, and let's get started. My name is Meredith Murphy, and I'm a partner at Smith Emerson in our tax and estate planning group. Today we will be talking with you about the Biden administration's tax proposals and executive compensation. So as most of you have probably seen in the news, the Biden administration recently came out with the American Jobs Plan and the American Rescue Plan. Both of these plans contemplate spending over $4 trillion over the next decade. This spending is in addition to the spending that already occurred with the CARES Act and the most recent stimulus bill. It's clear that the President and Congress will have to figure out a way to pay for the spending that has already occurred and for these new initiatives. Our prediction is that tax laws will be changing and taxes will be increasing for both individuals and corporations. Next slide. Next slide. So on March 25th, 2021, Senate Budget Committee Chairman Bernie Sanders fired the opening shot in the debate over raising taxes by holding a hearing entitled, "Ending a Rigged Tax Code, the Need to Make the Wealthiest People and Largest Corporations Pay Their Fair Share of Taxes." So Senator Sanders gave a lengthy preamble to his proposed legislation and talked about the 1% paying for the 99%. At the end of his preamble, he acknowledged that there was no unity within the Democratic caucus as to the increase in taxes and his proposals. Next slide. So even without unity in the Democratic caucus, there are some things that we do know now. Currently, the federal estate tax exemption is set at $10 million indexed for inflation. So for 2021, an individual is allowed to pass $11.7 million per person or $23.4 million per couple at death, or they can give this amount away during lifetime with no imposition of gift or estate tax. So under current law, the exemption is scheduled to sunset in the year 2025 to $5 million indexed for inflation. Or right now, we're predicting that indexing will end up with an estate tax exemption of about $6 million per person or $12 million per couple. Next slide. So the IRS has issued guidance stating that if an individual gives away money in excess of the estate tax exemption, or if they give away $11.7 million or more, or I guess next year will probably be indexed to about $11.9 million between 20 and 2025, and the estate tax reverts back to $5 million. There will be no clawback of previously made gifts, and so there will be no penalty if you give away more than that $5 million exemption in the next 4 years. Yeah, so President Biden has also set forth the Made in America tax plan, which Joe will go into detail on in just a minute. As a part of President Biden's proposal, the estate tax will be reduced to $3.5 million with no indexing for inflation. Traditionally, debates over the estate tax have been heated, and inevitably the family farm and the small business owner with no liquidity is brought into the debate, and Congress usually votes no on any changes to the estate tax. But even if President Biden gets no traction on lowering the exemption to $3.5 million, the estate tax is still reverting back to that $5 million now, and many more Americans are going to be subject to the estate tax. So I'm talking and advising my clients that now is the time to really do some estate and gift tax planning, or at least start thinking about planning, because there is some really, really great opportunities in the next 4 years to mitigate and reduce that estate tax. And currently the estate tax rate is at 40%. It will be increasing to about 45% in 2025. As to the corporate tax rates, President Biden has proposed increasing the corporate income tax rate from 21% to 28%. He has also proposed creating a minimum tax on corporations with book profits of $100 million or higher. This minimum tax is structured as an alternative minimum tax. Corporations will pay the greater of their regular corporate income tax or the 15% minimum tax while still allowing for net operating losses and foreign tax credits. So I'm going to turn this over to Joe Demko to talk more about President Biden's tax proposals.
Well, thank you, Meredith. Good morning or good afternoon, depending on where you guys are at. My name is Joe Demko. I'm a tax and corporate partner in our St. Louis office. I primarily work with individuals and small to medium companies in all transactional and tax matters. To start off, I just want to highlight a little bit about what Meredith says, that now is a good time to do gifting. So I know for all you parents that may or may not be listening to this presentation, it's a good time to start gifting money to your kids. And also, before I get into it a little bit more, we did get a question before the start of the presentation, so I want to go ahead and knock it out now to get it out of our queue. The question was posed: will raising corporate tax rates offset the deficit, or are we going to raise it through all the government programs? I don't know specifically what government programs, but certainly raising all these taxes, everything that we're going to be talking about today, is designed to offset the deficit or to reduce the deficit as much as possible. Certainly the government has been spending an awful lot of money the last few years, and more so than normal for COVID and for everything else. So with those things in mind, yes, all of these things that we're talking about are geared towards that. You know, the difficulty, of course, with all of it is we don't know. We don't know what's going to happen. We don't know exactly how things are going to look. So the purpose of this, the entirety of this presentation is really just to highlight these things for you so you keep them in the back of your mind. So at the end of the day, as we get to the third quarter, even before, really got to be taking a close look at especially your individual taxes for the things I'm going to talk about, and also estate taxes to see if there's any last minute planning that you can do. Because a lot of the things that we're going to be talking about are new thresholds. Biden's proposing a lot of new things. So without further ado, let's go ahead and jump into those things. Meredith talked a little bit about the state tax and corporate tax. I'm going to focus primarily on individual taxes. And there's a plethora of things that Biden is seeking to do to raise taxes on individuals. But no, and I'm sure that everyone recalls from the election, and as recently as March 16th, in an interview with George Stephanopoulos, Biden stated that anyone making more than $400,000 will see a small to significant tax increase. If you make less than $400,000, you won't see a single penny in additional federal tax. That's it. That sounds great to people that are making less than $400,000. But what is not clear is who is anybody. When Biden refers to anybody or person, it is not clear what that means. And what I mean by that, for a lot of our tax code and a lot of other things, tax brackets, phase outs, and all those things apply differently to individuals and to joint filers. So is he talking about $400,000 for individuals, or is he talking about $400,000 for a married couple? And in some of the things we're going to be talking about today, it's clear that he wants them to apply to individuals, but in other things like tax brackets, it's not as clear. So there has been a lot of commentary on that in the last few months, but there's still no clear answer. So like most of what we're going to be talking today, there's not a clear answer. We'll just have to wait and see. The remaining portion of my time that I'm going to be spending is going through more salient proposals of what Biden is seeking to do as far as his tax policies, at least the next several years. And these things, as they're summarized here on this slide, are changes to tax brackets, increase in capital gains rates, limits to itemized deductions, expanded credits for lower income individuals, further limits to the 199A deduction, which is the qualified business income deduction that President Trump put in, and then expanding payroll taxes. All these measures, just these six, are estimated to raise tax revenue over $3 trillion over the next decade. And one final note before we delve into these details is that it is unlikely that any of these tax provisions will be applied retroactively. So what that means is that if Biden is able to get these through in 2021, they likely won't apply until 2022. And why that's important is that a lot of things and a lot of these thresholds we're going to be talking about don't take effect till next year. So that gives you time to do the planning this year. And why at least I am fairly confident that these things will not be retroactive. They do have the ability to be retroactive, but there's some constitutional thresholds that they have to get over. But retroactive application of taxes is very unpopular. And in today's climate where the Senate has razor-thin control for the Democrats, they can't afford to lose a single Democrat. So the likelihood of any retroactivity for these taxes is very unlikely. Not to say that some of them might not get through, but for the lion's share, I'd be surprised if they are retroactive. So again, there'll be some good planning opportunities through the end of this year up until filing date. So without further ado, let's get into some of the details So next slide, please. All right, so here's a summary of the tax brackets. We have the current rates and then the Biden's proposed rates. So where I pulled this slide, at least, and this is one of the things that's very unclear on where those dollar amounts are going to fall and what's going to happen exactly at $400,000. But what's clear is that Biden's proposal is to restore the top marginal rate of 39.6% to those that are making over $400,000. Again, it's not clear if that's going to be $400,000 per individual or for a married couple, because certainly a married couple with two individuals can make up to $800,000. So it'll be interesting to see where that comes out. But that just shows the importance of bracket management going forward for many taxpayers towards the end of this year. So what this does, whenever tax rates are moving, whenever you get into the higher brackets, when those rates start to go up, many taxpayers decide to harvest gains. You can make Roth conversions, you can defer expenses and losses, you can decide to exercise stock options and make large charitable contributions. All of these things can help minimize the impact of taxes on their 2021 or 2022 income, because the left-hand side is likely going to apply for 2021, and those rates are going to go up in 2022. So to the extent that you can accelerate income into 2021 and pay slightly less tax, that might be a good idea. So depending on the tax brackets and what we talk about later as far as capital gains. And also, as an aside, if charitable giving is something you like to maximize in 2021, there's numerous things that can be done. Certainly people are familiar with outright gifts, but there are also many donor-advised funds and other private foundations. You can set up a private foundation and fund those with dollars today so you can accelerate that deduction. And all of these tools, again, should be reviewed throughout the year to make sure that they are done prior to the new tax rates becoming effective. Okay, can we see the next slide, please? Okay, so as we alluded to, so in addition to the increase in ordinary income tax rates from the previous slide, Biden also proposes to eliminate the 20% capital gains tax rate on gains over $1 million. Historically, if you held an asset for over 12 months, you were able to get a capital gains tax rate on that gain, which is presently 20%. Biden is proposing to eliminate that for anything that's over $1 million. So what does this mean? So towards the end of the year, if you have something you have capital gains on, you're considering selling it in the near term, within a year or two, certainly would make sense to sell that at the end of 2021, pay a 20% tax on it, rather than selling it January 2022 and paying 39.6% tax on that, effectively doubling your tax on that sale. And Biden also proposes to eliminate the step-up in basis for inherited assets. So as a result of this, heirs would be responsible to pay the tax on built-in gains on inherited assets. So if mom and dad gifted you a bunch of Amazon stock that had a really low basis, great, you got it, you sell it, and you're going to get hit with a huge tax. It's unclear to me how this would pair with the estate tax exemption. There's been lots of commentary on if the estate tax exemption goes down, it has to somehow be offset by the basis step up. They shouldn't be able to lose both. So I don't know how that will pair if Biden is successful getting the exemption back down to $3.5 million, but it's certainly something to keep in mind. And that is capital gains. So next slide. So now we'll go on to itemized deductions. Biden is proposing a cap on the tax benefit of itemized deductions at 28%. So what that means in the illustration I have on this slide, assuming an individual has a $40,000 itemized tax deduction, if they are in the 37% tax bracket now, they are receiving a 37% benefit on that. Yes, I'm sorry, I was looking at my percentages, and 35% was 14,000, 37% was 14.8. I read that to be both 14,000, so I thought I had a typo, but that is correct. So 37%, they get a $14,000, $800 tax benefit. Under Biden's proposal, that would be reduced to $11,200. So those in lower income brackets are going to get a larger tax benefit from those itemized deductions. Furthermore, Biden's also proposing to bring back the piece limitations which were enacted by Donald Peace in 1991, which reduced deductions on a percentage basis of the taxpayer's adjusted gross income. So what this could do is reduce the tax benefit further of itemized deductions by as much as 80% for high earners. And according to Biden, high earners are those that are making over $40,000. And it's also, as another side note, it's not clear if Biden will retain the $10,000 limit that is currently in place for itemized deduction for state and local taxes. The House has tried to do this in the past, but it hasn't been successful thus far. But this loss of deduction hits those in Democratic strongholds more severely, so I wouldn't be surprised if that $10,000 itemized deduction limit gets repealed. Okay, next slide, please. So the next thing I'm going to cover are individual tax credits. We're going to go through 5 of them. These likely won't apply to many of the people on this call because, again, a lot of these are geared at lower income earners. But we just want to go through them so you know that they're out there, and these are all, you know, incentives that are going to be paid for with our other taxes that are on the high earners. So the first one that we're going to be talking about is the earned income credit. The earned income credit is a refundable credit based on earned income up to a threshold amount. And then it's also, there's a calculation that's based on the number of qualifying children. So for all of these credits and for everything, there's lots of definitions. These definitions always change, and they really take time to go through, you know, to see if you qualify for these. I, myself, doing my individual taxes, I'm depressed every single year going through these credits when I find out that none of them apply to me. And I'm not a high earner or anything along those lines, but a lot of these things, the phase outs are extremely low. For instance, earned income credit, the phase out for 2021 is at AGI at $57,000 for joint filers. So that is a very low threshold. Biden does propose to expand this credit for childless adults because as it applies now, it just applies with those with children, or the calculation is dependent on it. Okay, the next one we're going to talk about is the child and dependent care credit. And I apologize ahead of time for going through these quickly. There's a lot of information. We have a lot to get through. So follow up with questions or anything else. So the child and dependent care credit is a non-refundable credit for a portion of qualifying dependent care expenses that allows a taxpayer to go to work. So for a married couple, or for singles for that matter, it's if you have daycare or anything else where you're paying money to watch your children or qualifying dependents so you can go to work. This does not apply to at-home babysitters and people that you're not wanting to disclose on your tax return. So for a lot of people, if you have a nanny that comes and watches your kid after school, that person is not going to be a W-2 employee, and you're not going to be disclosing those payments to the IRS, so you will not be able to use those amounts for this credit. Biden proposes to increase the credit from $4,000 for one child and $8,000 for more than one child. No, I'm sorry, that's what he proposes to increase it to, $4,000 for one child and $8,000 for more than one child. The maximum credit based on a calculation is currently at $1,050 and $2,100 based on the number of qualifying individuals. Okay, the next one we're going to talk about is a child tax credit, which is a credit for a qualifying child under 17, and this is currently $2,000 for each qualifying child or dependent. And this one is phased out at $2,000 for single files or $400,000 for joint files. So child care credit certainly applies to a lot more people than either the earned income credit or the child or dependent care credit. Biden proposes to increase this credit to $3,000 and $3,600 if the qualifying child is under the age of 6 years old. So Biden's going to give you an extra $600 if you have a child that's under the age of 6. And then a couple of new things that Biden is proposing, or the first isn't really a new thing, it's just kind of a resurrection of first-time homebuyers credit that we had in 2008 and 2009. But Biden's proposing a $15,000 first-time homebuyers credit to be used towards a down payment on a home. This credit is unlike that in 2008. I don't know if you recall, I know one of our listeners on the phone personally did qualify for this credit originally. In the 2008 credit, you had to repay. So you took in 2008, and then you lost half of that benefit. I think it was in 2009. So unlike the previous credits, it's going to be a full credit, and it's not going to be repaid. And the last thing we'll talk about is renter assistance. The government, with COVID and for everything else, has put a lot of moratoriums on evictions and all those things. They've been helping renters and landlords to help, frankly, to fund their loans and all the debt that's associated with property. So that has been going on. Biden is also proposing relief for taxpayers whose housing costs exceed 30% of their income. So in addition to all of the things that has already been done or has already been done for renters as far as allowing them to stay in their homes, going forward, Biden is proposing that housing costs, if they exceed that 30%, will be given some type of deduction or credit. I'm not sure which. It seems neither of those are particularly useful for people because you won't get them until you file your tax return. So as far as staying in a property, it's not going to help you, but it will help you for prior years. So it won't solve short-term problems, but it will make housing more affordable going forward. Okay, the next slide. So now we're going to get back into some of the business items. So I'm going to be speaking, I think, on two more topics, and then we'll pass it over. The first one I'm going to talk about is the business income deduction, which is what President Trump put into place that provides a 20% deduction on qualified business income through 2025. Don't know how many listeners on the call have tried to fill out the form for this. It's a very, very complicated form. And it's very complex, and frankly, if you can do it on your own without the assistance of your accountant, perhaps you should change professions and become an accountant if that's not too boring for you. As you can see by the slide, there's three different numbers, or with a zero, there's four, but there's actually three different sets of tests currently. Below $326,600, the deduction is basically 20% of qualified business income. So then you get into what the definition of qualified business income is, and I don't want to go through all of these definitions as we'd be here for another half hour or so. But basically, it's going to be anything investment related, so it's not wages, it's not W-2 income or other things you're getting from providing services. So they're giving you a deduction. So again, this deduction was to help incentivize investment. So below that threshold, deduction is basically just 20% of your qualified business income. Over the $426,600, the deduction is subject to several limits. It's limited based on your capital count within that investment, so the capital limits, and it's also dependent on the W-2 wages that are paid from that company and whether the business is a specified service business. So a specified service business is similar to what it sounds like, but probably not exactly, but they're businesses like accountants or other advisors that are giving services based on their time and not on capital. So again, this whole deduction was to incentivize investment. So they didn't want to incentivize investment into service-related companies as much. So over $426,600, the deduction is subject to those limits. Now, the confusion here certainly comes in between the $326,000 and $426,000 levels. Between there's a phase out. So all of the limits that I just discussed in relation to over $426,000, they do start to apply at $326,000, but they are phased in during that time. And then you'll also notice that there is a new $400,000 phase out number that's inserted there. Biden is proposing to phase out the deduction completely at AGI of $400,000. That is not clear to me. That's going to be $400,000 of AGI total income and not just based on the qualified business income number, which is what the current is. So that could be a pretty big limit to the business income deduction that people have had the last several years. But again, that does sunset in 2025. So if nothing gets done, it's going to go away anyway. Okay, next slide. Okay, my last topic before I turn it over is the, yes.
Joe, can I interrupt with a question? Maybe you can answer it, but before you move on to the Social Security tax,
please, yeah.
There was a question about our trust tax rates raising as well.
Truck, like semi-trucks?
Trust.
Oh, trust tax rate.
Right.
Yeah, absolutely. So trust in general will have to pay their own income taxes, and historically, trust pay income taxes on an accelerated rate as opposed to individuals, and that is certainly something that Biden proposes to go up because, again, remember the comments at the very beginning from Bernie Sanders, and in my comments regarding the $400,000, that the ultimate goal for a lot of these is to get the rich or the high earners to pay more tax. So they're certainly not going to want to incentivize high earners to shift more money to trusts so they could avoid taxes. So absolutely. So there are going to be different tax rates, and those aren't summarized here, but that is certainly something that is going to be addressed with Biden. I think that answers the question. Okay, so the last thing I'm going to talk about is Social Security tax expansion. So as you can see on this slide, the Social Security wage base is currently $142,800, and on that portion, employers and employees are paying combined 12.4%. Biden is proposing that at $400,000 that comes back. So anything over $400,000 is going to get hit with another 12.4%. So what this does effectively, it creates that gap. So between $142,000 and $400,000, you have a gap where you're not going to be hit with that additional 12%. So this really creates an opportunity for individuals to accelerate income to stay in the gap or defer, depending on where you come. But if you're up at $390,000, I have a client that's happened to last year for a different purpose, but if you're up at $390,000 and you have the ability to defer, $100,000 payment at the end of the year for a few months, it certainly makes it well worthwhile to defer it into the next year so you don't bump up to that $400,000 and bump it to the next year so you save it. This can also be done in some other planning mechanisms that can be employed here as well, or S-Corp distributions, because distributions from S-Corps, of course, are not subject to self-employment tax. So Social Security does apply to wages, but it also includes it also applies to self-employment tax. So to the extent you can take these distributions as S-Corp distributions, you will not be subject to Social Security tax. Still need to pay close attention to reasonable comp, because the IRS can always come back in and challenge you didn't pay yourself enough money. Because as owners of the S-Corp, you do have to pay yourself reasonable compensation if you're providing services to the S-Corp. So with all of this and with the increase of Social Security at the 12.4, employees could face an effective marginal tax rate of over 55% starting in 2022. So to me, this highlights the importance of diligence and planning and closely monitoring what your income is throughout the year. Now, this planning is a little bit easier for W-2 employees who are salaried to know exactly what your income is going to be, but for people that are generating income through businesses or through other investments, it's really important to monitor and time the recognition or realization of that income or gains going forward. And with that, I'll just say it's very important to stay up to date with all of this. We will be creating lots of posts and web postings and articles as things transpire throughout the year. But anytime, feel free to reach out to me or anyone else, and we'll be around for questions later. I just want to make sure that I do point that out, that I am happy to take any questions or anything else. My email and direct phone is at the end of the presentation. But with that, I will pass it to Rebecca and Kelly.
Not so quick, Joe. You're not done yet. I have a question for you before I take on the next slide. So
okay.
Someone has asked for clarification about the 12.4% above 400,000 and whether that will be split with the employer.
Yes, so that is to both. So it all depends on who the employer is, right? So if it is with the employer, absolutely. The employer is going to be responsible for their portion, and the employee will be responsible for their own portion. Where I said it depends. There is that split for the W-2 employee, but if you're self-employed, it's all on the self-employed person.
Okay, thank you. Good afternoon, my turn, everyone. I'm Rebecca Bush, as Joe mentioned, and I'm here today with my colleague, Kelly. Say hi, Kelly. You're probably on mute.
Yeah, good afternoon.
Kelly and I practice employee benefits, which, is employment law crossing into the tax realm, and that's kind of why we're here today on the back end of this presentation, of this, kind of depressing presentation, if I have to say so myself. But that aside, we want to take maybe a little bit more of a proactive approach. Joe mentioned one thing with the last slide in terms of Social Security tax, and these are all contemplated changes, right? This is nothing that is actual legislation right now. This is just, on the agenda, and I believe we're still within the first 100 days of the Biden administration. So, it's important to know where the intent of where things are headed, so you can plan possibly appropriately. And one of those things is in designing compensation for your people or for yourself if you own your own business. And Joe mentioned with the Social Security tax, if you're close to 400, do you want to, defer the income if you have that ability? And one of the methods for deferral and different way we defer income and that's also being affected are 401k, and I wrote 401k type plans, right? So what's the issue? What's the problem here? Why are people complaining? 401ks have been around a while. Nobody's complained about touching them, but the issue is when you defer, you lower your taxable income, right? So if I'm in the highest tax bracket today, the goal is that I'm, deferring it to retirement when I'm in a lower tax bracket, and then I pay less income on that. Or I move to a state like Florida that doesn't have state income tax and save, and, there's all these different tax strategies. But the current deduction system doesn't incentivize lower compensated workers, at least not to the extent that it incentivizes higher compensated people. And, if that's the theme here today, I mean, that was Biden's campaign promise, right? That he was running to help the average worker, the lower compensated worker. And so this theme and contemplated changes with 401k type plans is certainly no different. According to a March 2021 Forbes article, 48% of people 55 and older have no tangible savings. I mean, when you see these statistics, they are kind of alarming. 37% of those with retirement accounts don't understand how they work, even on an elemental basis. I could go into that for a whole separate PowerPoint, and it will spare you my soapbox, but that is part of the reason is, 401ks weren't intended to be the primary savings vehicle for employees. They were meant to be supplements for higher compensated individuals to supplement traditional pension plans. Can you do the next slide? So the issue comes in, okay, well, so it's to defer income. Well, how does it favor highly compensated? We're all putting, we're all making our money, putting it aside, whatever we can, and matches, where employer contributions are what they are. And so I thought it would be helpful to explain in some examples here because I'm an examples kind of person. So you see in example one, and I mentioned Roth provisions aside because Roth, if your 401k plan has a feature where you can contribute after tax, that's obviously a different thing where you're not deferring to defer taxes. So if you're making a salary of $100,000 a year and you're in the 24% tax bracket, that 10% contribution of $10,000 saves you a $2,400 deduction, right? Because otherwise you would pay that's what you would pay taxes on that $10,000. So in essence, it's $24 for every $100 in deferrals. If you made a salary of $35,000 a year, you're at a 12% tax bracket and you contribute the same 10%. Of course, that's less money, so less deduction. But if you pare it down, from the $3,500 to the $420 reduction, and you pare it down to, savings per $100, you see easily that that's $12 for every $100 in deferrals. So there is less, half the amount of the tax incentive for somebody making, $35,000 versus $100,000. Next slide. So what Biden's proposed alternative is and what they're looking at, and I've seen some contemplate of different tax rates or different tax credits of either 24 or 26%. But the concept is that you would replace this tax deduction and the savings of that with a refundable tax credit. So refundable being, necessary because those in lower income brackets don't sometimes owe taxes. So refundable means you would get it back even if you didn't have a tax obligation, right? You get this credit of 26% for everyone. So, and remember, there are limits on how much you can contribute. So there's already limits in terms of highly compensated people and how much they can put in a plan, such as a 401k type plan anyways. And you do have the issues, with highly compensated and other thing where with discrimination testing, where oftentimes highly compensated people get their money back because they contribute and are more likely to contribute than lower compensated people because they have the bigger tax incentive, amongst other reasons. They also have more disposable income, but that issue aside. So the same examples, the same brackets, the salary of $100,000 a year, 24% tax bracket, the savings of a 26% credit it'd be a $2,600 credit. So this individual at $100,000 would still, have a little bit more savings versus $2,400. but then they would save $26 for every $100 in deferrals. Yet a salary of $35,000 a year would still lead with 10%, $3,500 total deferral contribution. You have a $910 credit, and if you prorate that, it's still the same then, $26 for every $100 in deferrals. So that sounds like a great solution, right? Let's go to the next slide, and I'll tell you my problems. So the problem is, and where this becomes an issue for higher compensated people, is if you recall when Joe laid out the tax brackets and the increases to certain brackets, well, there's a decent chunk of the population getting, or in those bracket ranges, getting more than a 26% tax imposed. So if you are in that income tax bracket where, you're at, let's say, 39% in the higher compensated individuals, well, this is going to lead to a dramatic difference in your deferral, because normally you would get almost a 39, you get 39%, almost 40% deduction on your income. And with this plan, if you were deferring, you would only have that same savings of the 20% tax credit. So tying back to Joe's slides earlier, I believe, is saying the current rates for 2021. So if you're starting at $163,000 for singles, starting at $326,000 for married. So the thing is that, if you remember my last slide, this makes sense because that individual was making $100,000 and they were still better off, slightly better off with the tax credit. So these are kind of the income brackets where it starts to make a difference. And, I know, practically speaking here for a minute, that, Kelly and I work a lot with employers in 401k plan design, compliance, administration, and 403B, and other retirement plans as well, which Kelly will talk about in a second. But I know some employers, the 401k plans have not been a perfect fit. So I don't know if this is necessarily addressing the issue, for example, for a restaurant with lower compensated workers who have a lot of tipped employees and don't get money on their paychecks. And, what does it matter what the tax credit is? And is a lower income person going to really use this to incentivize them to contribute? But those philosophy discussions aside, this is, important to know that this is what's on the agenda. So when you have employees at this income level, you may want to look at or start thinking about what else can we offer to help compensate, or to compensate in a way similar to how, Joe mentioned the planning in regards to the Social Security tax deduction, because this would tie into that as well. So I'm going to turn it over to Kelly for a bit so she can talk about some different ideas and ways to, one last thing about 401k plans. Sorry, Kelly. Sorry, I was just tricking you.
Oh, sure.
Make sure you're listening. And no, correct. Next slide. One last issue on 401k plans is that the Biden's agenda also talks about, I'm talking about these other people who don't contribute. So one of the other ways Biden's agenda is looking at is the private-based or government-based 401k alternative plan with an automatic enrollment feature. And then catch-up contributions permitted for caregivers. Who are caregivers, right? People who take time out of the workforce to care for other individuals and lose time out on contributing to retirement. So giving them some type of catch-up contribution, the same way you do to older workers. And why? Because again, like I mentioned, there is a lot of lower compensated people that don't participate, right? And in some of that, 35% of private sector workers don't participate because they can't. Because they work for a company that does not even offer a 401k retirement plan. And, as I mentioned, the problem in restaurants and other industries where there's a lot of lower compensated individuals who don't participate, I mean, that traditional retirement vehicle doesn't work for them, because you put that in and just your highly compensated people contribute, and you either have to fund a safe harbor and deal with those issues, or you're just returning funds to your highly compensated people, which defeats the purpose. So now I am going to turn it over to Kelly. This time for real, Kelly. Sorry about that.
No
to
problem.
add on to anything, because I know we have a similar feature in Illinois, kind of, if you want to add about that or anything, and to talk about some other alternatives for planning means and different retirement plan options.
Sure. And before we do that, I have a question for you on the 401k. So if Biden goes ahead with this proposed alternative, do you see this requiring any plan design changes on the employer side, or is this strictly going to affect how employees are taxed and their payroll? Or do you see this requiring changes to the actual plans on the employer side?
Right now, based on just the proposals out there, it's just about the tax rates and how those work in terms of when individuals file and reconcile. So, I mean, I don't see anything right now on the agenda that would lead to a plan design change. The plan design changes are kind of what Kelly, Kelly's designed to talk about next in terms of practically speaking. You know, are you going to then want to make something available for your higher, to be creative with your higher compensated workers?
Yeah, perfect. We also had a quick question that said, does this change affect Roth 401k? No. And so, right, because that Roth 401k, those contributions are not, are taxable at the time they're contributed to the plan. And so that would continue.
Right, because this issue is only about who's allowed to defer, and when you defer, what tax savings do you get for that deferral? Roth, you're not really deferring the tax, you're paying the tax on it right today. So there's not a deferral in that perspective. Yeah.
So, okay, well, thank you. So the question becomes, as you just so nicely handed off to me, is what else can an employer do for some of their higher earners who may be losing some of the tax benefits of deferring their income into the 401k? And there's a handful of things to be thinking about. So, and one of those is something we would call non-qualified deferred compensation plans, which is really a very large bucket of things, of types of arrangements. It's really anything that defers the receipt of income and the taxation of income from one year to the next, outside of a tax qualified plan like a 401k, 403b, 457b plan. And so these non-qualified deferred compensation plans or arrangements are subject to a fairly onerous part of the tax code, section 409A, which presents some pretty strict timing and distribution restrictions for these types of arrangements. But when you're able to kind of work within those restrictions, this can be an important tool for your higher earners. So what something like this would do is it would allow executives to postpone taxation until the actual receipt of payment under this non-qualified plan. Similar to how a 401k works, but it's not, again, under the qualified plan, not under a 401k plan. So it would be some other type of arrangement. So why is this potentially desirable? The assumption being that the tax rate at the time of receipt will be lower. So, somebody may have, the idea is that you have less income in retirement or at a future date. You may hope that tax rates will be lower, but even if tax rates themselves are not lower, the assumption may be that in the year that you receive payment for this income that's been deferred, the executive will, no longer be earning as much money and will find themselves in a lower bracket. So income under Section 409A, income can be deferred if there is a substantial risk of forfeiture. And so what does that mean? That means that there has to be, so the executive cannot have a binding right to payment that is, the payment cannot be funded. So, for example, cannot be placed in a trust outside the reach of general creditors of the corporation. So as long as there's some type of risk to the executive, meaning, and the risk can be something as simple as, that if the employer goes under, for example, or, is no longer in business, that the executive gets in line with all other creditors for the amount that they would earn under this plan. So at any point where they have an absolute right to the payment and there's no risk of forfeiture, then it becomes taxable income under the revenue code. So as long as there's some type of substantial risk of forfeiture that meets the requirements of 409A, income can be deferred. So there's a whole plethora of ways that employers can structure non-qualified deferred compensation plans. There are plans that can allow an executive to defer their own income. So it works similar to a 401k plan where an executive would choose to put in a certain amount of their pay. It can be, sometimes there are plans that allow executives to defer bonuses only. Sometimes there are plans that allow executives to defer, a portion of bonus and salary. It's really up to the employer on how something like that wants to be designed. These types of programs require an executive to make an election the year preceding the year in which their money will be deferred. So if they want to receive, or want to defer 10% of their salary in 2022, they'd have to make an election under a non-qualified deferred comp plan by the end of 2021. But if they do that, then they have the ability to, defer that portion of their income. So, but one way is it's called an elective deferral plan. Another way, another type of programs that we see are employer-only non-qualified deferred compensation plans, where an employer may provide an additional amount of compensation that is then not deferred. That is deferred and not taxed until received by the executive. So potentially, maybe instead of bonuses, they're going to provide, they're not going to make it elective, they're going to make a contribution to a non-qualified deferred compensation program on behalf of the executive. Or maybe they want to put in what sometimes you'll hear the term SERP thrown around, a supplemental executive retirement plan. Those are often a type of non-qualified deferred compensation plan. So maybe they want to put in something like that. So these programs are pretty flexible as long as they meet the restrictions under 409A. And by flexible, I mean they can pay out, well, they must pay out only on a handful of certain events. So they don't allow an executive to sort of choose when they want to receive the money, because then the IRS doesn't like that, because if you can say, I want my money now, then you should be taxed on it. But an unqualified deferred comp plan will be compliant with 409A if it pays out on termination of employment, the executive's death or disability. A certain date is a viable option. So sometimes you'll see plans where it may pay out on the date the executive turns 65. Or if it is, you see elective deferral plans that may say, I want to defer this amount of income for 5 years. So it pays out, on the date 5 years from the date of the election. And then these can also pay out on a change of control. So there's some parameters around how it can be designed, but you generally can accomplish a lot of different things with a program like this. So a couple other thoughts I have, really as I was listening to everybody else talk today that aren't on the slides, things that you might want to potentially consider for executives, is if they're, and this really stems out of the higher personal income tax rates rather than the changes to the 401k, is there may be more interest in there are some types of what I would call equity plans or stock programs that can be tax favorable to executives as opposed to traditional options that are taxed as ordinary income. One example is employers can provide restricted stock to executives, and executives sometimes can have, depending on your plan, can have the option to be taxed at the time they receive it instead of at the time, say, the restricted stock vests in the future. And so they're still taxed on the value of restricted stock they receive, but if you set up the program right, any growth in the stock price, so say your organization, you really believe it's poised for an increase in value, any growth in the value of that stock after they receive it, and if they do what's called an 83B election, and after they're taxed on it as income, any growth can then be taxed at capital gains rates. So even if they don't vest in that stock for a number of years, the amount that's earned over that period of time via the growth of the stock can be taxed at capital gains rates, which as of right now is generally lower than ordinary income tax rates. Another option is certain types of stock options called incentive stock options, which have some specific parameters around how those are designed. But those, the income that an executive may receive or a person may receive when they exercise an incentive stock option can often be taxed at a capital gains rate instead of an ordinary income rate. And so that I expect to see kind of a resurgence of those types of programs that may allow the executive to get a little bit of tax benefit there instead of their flat ordinary income rate. So we can go to the last slide now. And then some other alternatives to consider, and this is a kind of an evergreen question we get all the time, is what else can we do for executives? You know, there's some value in perks that you can provide to executives, and some of these may be taxable as well, but they you know, can provide value in different ways. And those include, you know, mobile phones, laptops, electronic devices, company cars, obviously, are important. Executive life insurance, there are some ways to, this is often a valuable benefit to, you know, higher earning executives, particularly if they are interested in estate planning or other types of, you know, ways to kind of leave wealth to their dependents. Providing financial and legal services can be really valuable for executives. And then things like supplemental medical, long-term disability plans, recreational facilities, et cetera. One thing about long-term disability plans is if you could structure those right, you can, you know, the value of the premiums may be taxable to the executive, but then any benefits that they receive would not be taxable. So in the event somebody, you know, incurs a disability, that can be tax advantaged. So there's a variety of things that you can do to get creative to provide some additional value to your executives in light of these tax changes. And that's really all we have today, I believe. So I think
There is one question that I tried to respond to. I don't know how these things work, but we did get a question that I'll handle. That I was asking my opinion on the likelihood of whether or not the step up in basis will actually pass. And when I was offline, I consulted with Meredith, more of the same opinion, that the likelihood of step up in basis being eliminated is very rare as long as we have an estate tax. Good example of this is in Canada. They have no step up, but there's not an estate tax. It'd be pretty bad to have both of those things. If you are going to be taxed, the state be taxed, and then also the beneficiaries be taxed on that built-in gain. So I think the likelihood of that passing would be very, or is very small. And I think that's all the questions that we had in there.
Great.
Thank you.
Thank you, everybody. This slide has all of our contact information. If you have any questions, want to reach out to any of us individually. And as Meredith mentioned in the beginning, the slides, watch in the next 24 hours or so for an email with the slides so that you all have a copy and can access those at a later date. If you don't get them, please check your spam folders or reach out to us and we can facilitate a duplicate email. Thank you all for attending and have a great day.
Thank you.